from Exness, and he's going to be talking to us about where could the US stock market be heading in Q4 of 2021. So welcome to the stage, Wael.
Thank you so much. Thank you. Hello, everyone. Thank you all for joining here. I hope everyone is well. So I decided to talk about the US stock market going into the fourth quarter. As we all know, September is a bad month for stocks historically. And we witnessed during the past couple of weeks the downfall that we saw. We were trading at record for S&P, Dow Jones, and Nasdaq. And now we're almost 5% down off the tops. So first, we're going to start with showing the past performance for US indices, especially the S&P 500. I'm going to dissect the returns on yearly basis and on weekly basis since 1927 till today. And then we're going to go over some sectors to check which sectors are overstretched, which are undervalued, which could have some opportunities. What are the good industries to invest on the medium to long term? And then we're going to highlight some of the bullish and bearish factors for the market going into the fourth quarter. And we're going to finalize with a technical analysis on the S&P 500. So first, this is yesterday morning before the drop that we had yesterday during the day, around 1.5%. So up to year to date, the S&P is now almost 18% up on the year. Nasdaq is around 16% and the Dow Jones around 13%. So we're down almost 1% from these levels that were highlighted yesterday in the morning. You can see a clear uptrend. We had some corrections earlier in March, especially for Nasdaq. We're going to talk about this in a while. What was the reason for this drop? And then we were able to recover, and then the market went to new highs. And when we started September, the market corrected a little bit. So what's behind this rally? What caused this rally? Thanks to the Federal Reserve and the ultra-loose monetary policy, a lot of asset purchases. Thanks also to Trump previously and now Biden, all their spending plans, the CARES Act. A lot of money was pumped to the markets, to the economy, and this was translated with good returns to the market. So this is the S&P 500 since 1927. We can see the crash back then, and then how it was trending upward. Despite all these moves down, we had 3 secular trends, and now we're still trading at record high. So all these dips that took place at a time where the market was recovering and investors were able to see higher highs for stock indices, and this is especially S&P 500. Okay, so these in gray here, they are the recessions that took place. So since COVID, we were in a recession, but the stock market is performing positively. And as I repeat again, this is due to ultra-loose monetary and fiscal policy from central banks and from governments. We are on the verge of a change in monetary policy. We're going to be talking about this in a few also. So this is the annual return for the S&P 500 since 1927 until the present. So I decided to highlight this 20% benchmark, since a lot of people, they were mentioning during this year when the S&P 500 reached almost 20% in performance, they started saying that the market is overstretched, overvalued, we're going to look for corrections. But if you look historically, since 1927 till today, almost 30% of the time, the S&P succeeded to pass 20% or above in returns. So if we during the fourth quarter, we were able to recover, and then the market end up the year above 20%, this is also somehow normal for the S&P based on these returns that we are seeing. If we want to go more closer into this is a nice chart. This is from 1927 till today. These are the weeks, 52 weeks of the year. And this is the average performance of each week from 1927 until today. So you can see here, we're currently, if we're using the European calculation for the year, we're now in week 39. Usually week 39 is the worst for the year with an average drop of 0.7%. And now we started the week on Monday. We had a calm session. On Tuesday, the market dropped. Today, we're recovering a little bit, but on the week, we're still down. So if we're using past performance in order to highlight what's happening in the market or to predict what could happen, we can notice that in September, in September and October, we had 3 weeks down in September, 3 weeks in October, which suggests that if we lose some momentum going into the fourth quarter, we could be facing a slight drop in October, and then we could be heading into new gains going into the end of the fourth quarter, and then this could continue going into the new year. So now here we will have, at the end of the year, we have something called Santa Claus rally. It's the holiday season rally where stocks usually outperform. We have on average a return of 0.4% during the last week of the year, and then this continues during the first, the second, and the third weeks of the year. So if we're just going to base our assessment on this past performance, weekly returns from 1927 until today, we can notice also the seasonality. So here, this is in mid of May, it's week 20. Also this year, we had a drop in the same week. So this year, almost these seasonals, they were doing well. They were matching with the past performance. Now let's dive into the sectors of the S&P 500. If we just have a clear look on the top performing sectors, first we have the energy sector in the S&P, which is up 35.1% for the year. It's amazing. It's benefiting a lot from the reopening of the economy around the world, and especially with higher oil and energy prices. The companies, they're a little bit tight on spending. They're not going into more production investments like they've done in 2014. So they're trying to just make sure the market is settling near these prices, and they're trying to secure their profit margins. That's why these companies, they are they're outperforming rivals, and this is why we're having an outstanding performance for the energy sector this year. Financials, they're also benefiting. Last year we had a little bit of spending. Most of the economic activity around the world was shut, so people were saving money, and banks, they did benefit from those savings. They invested these savings. They had some returns. Also top banks, they did benefit from the volatility that we had in the markets last year, and this was translated into more returns for their investment departments, and thus we had outperforming sector. Also, we have now a promising higher yields, where also these banks will be relying on higher returns from US Treasury, so this will add their profit margins. So that's why some people are more bullish now on financials than previously. The real estate sector, we know that many investors prefer real estate in order to hedge for inflation. And also, if we have to look on the other side, we had ultra-low mortgage rates in the United States. So this supported or fueled the demand for real estate along. So it's very easy for me now to have a loan, to have a mortgage, so I can go and buy a house. If I have certain amount of that I can afford to buy a house, and I want to make sure that inflation doesn't erode my savings, I could go and invest in a house. And this is what happened in the United States. We've seen REITs trading at record highs. We've seen a housing market in the United States that's booming. Prices, they're up almost 15-20% in different places. So this is why we had a very good real estate sector this year. Communication services and IT. So this is also, it goes back to working remotely and using a lot of services of these companies that supported us during the pandemic and made us more into connecting with each other using their platforms. So definitely we're invested in this sector, and we've seen also outstanding returns. This is the S&P 500 generic. So these sectors, they outperformed the general S&P 500, while these sectors, the healthcare had an outstanding performance during the beginning of the year, but then going into a better shape with COVID, some investors favored having some profit after having a decent rally in the healthcare sector. So this is just why the healthcare is not as outperforming as others. Industrials, consumer discretionary materials, staples, and utilities were performing under the general S&P 500 returns. Okay, so this is here if we just want to also have a closer look on sectors. In red, it's the 200-day simple moving average. So by looking at these technicals, we can see which sectors are almost overpriced or overstretched relative to the S&P, to the simple moving average, the 200, which gives us a good signal whether we're just going far away with the direction. So you can see the S&P since May 2020, the S&P failed to close below the 200-day simple moving average. And this is the 5th record rally since 1993 for the S&P staying above the 200-day simple moving average. Many investors are just now expecting the S&P to retrace a little. We'll go over this in the technical analysis session to show you where does the 200 simple day moving average stand at the moment. This is the healthcare sector. So as I said, we have some profit taking at the top. We're seeing a bit of reversion to the mean. The communication service, it's still outstanding, very far from the moving average. This means that some investors could go into more profit taking going into the end of the year, and we could be facing a little bit of a correction. Industrials are already down. We had a double top in industrials, and then we moved back towards the 200 simple moving average. This is consumer discretionary. Also now we're still in times where investors, citizens, they're not fine enough now still with the fact to spend more money on discretionary. So we're not into a full expansionary phase now. So that's why these companies, they're still, if you can look at the performance of the sector along with the 200 simple moving average, you can see how it's very close to it relative to others. Also the IT and information technology, it's at record high, also far away from the 200 simple. Consumer staples, they're closing in since investors favored going into more aggressive sectors than those defensive sectors that had outstanding performance during 2020. So this is why we had in 2020 a bit of an overextension in this sector, and then we had corrections and reversions to the mean as the rotation took place with investors favoring more aggressive sectors than those defensive sectors. The materials are also there. They had a lot of movement lower. Since if we noticed during July and August, we have a bit of a drop of some of the major commodities, and this just translated into weaker materials sector during that period. If you just notice the difference between all these that we just showed, you can see clear uptrend in most of the sectors. However, if we look at energy, they suffered since 2006. They had a top here, and when the market collapsed in 2008, in 2008, almost prices were around 150 for a barrel. And then we didn't come any closer to these levels back then. So now, with this drop, energy sector suffered well when prices went into negative during 2020 and then started to recover. If we just compare this to energy prices, it's almost copying the price of crude. So with now more expectations of oil prices going into $90, there could be some room for energy companies to increase their profit margins going into the year end, which gives us good opportunity to invest in energy sector going to the year end. We're going to talk about renewable energies, but still, at the time being, energy sector looks promising with higher forecasts of more demand in 2022, with also OPEC Plus and other producers, they're sticking to low production. They aren't willing to invest in producing more. You can, if you want, you can review the number of rigs in the United States, how they're performing with higher prices. They're not as aggressive as previously. Back then, we used to see oil companies, when prices go up 20, 30%, they jump into investing in more production. They want more inventories to sell you in order to have more returns. But at the moment, they're not willing to do these investments. They suffered a lot in 2020. They went into more debt. So now they're not willing to sacrifice their profit margins on investment. And this could raise profit margins. If we have stability in oil prices for a longer period, then these companies will invest more in production, and then we could be seeing a bit of corrections in the energy sector. Real estate, as we mentioned, the reasons for real estate to move higher. So it's still outstanding. If you compare it to other sectors, real estate is just booming. And this is what's worrying a little bit the Federal Reserve, since people, they're not affording any more renting houses in the United States. It's coming a lot in their inflation figures. So that's why they have to try to normalize mortgage rates in order to lower demand on real estate so it's more affordable again to more people. The financials, Also, we were very far away from the moving average, and now we had a double top, and now we're moving back again towards the mean. With utilities, they were suffering. Since utilities, we know that mainly utilities, they don't outperform. They're more into defensive. Investors, they go into utilities searching for dividends. They have a cap for investments. So this is what makes utilities less appealing to investors in a very risky medium, or where risk appetite is at higher levels. Industries to consider. Who's not interested in machine learning and neural networks at the time being? If we just want to go into simple example, if now I tell you I have an automated system that does trading for you based on machine learning and neural network, the idea is so appealing for you. What if we do this to different sectors? What if we convince people that machine learning and neural network can change a lot of industries? And this could create a lot of investment opportunities. So a lot of money will be spent on this sector, creating more opportunities, more value going forward, and it is expected to grow significantly going to the coming years. So it's expected that this sector increases by 15 to 16% on an annual basis going to 2024. So that's what makes artificial intelligence an appealing industry to invest in. Virtual reality and augmented reality is a perfect escapism to people. So people, they go to virtual reality to escape what they are living. So these companies, the entertainment companies, they're building on this. They're investing a lot in virtual reality and augmented reality. It could triple in the coming 7 years. It's now almost around 21.7 billion, the industry. It is expected to grow to 70 billion. And we can know what 3 times in the financial markets means. So 3 folds, it means a lot going into a couple of years for certain industries. And data analytics, simply, who doesn't use data now in order to take decisions? It's not only in strategic decisions now. It's more into entering our operations, day-to-day operations. Now, most of our decisions, they are based on data. And top-performing companies, they are top performers because they rely on data in order to take their decisions. So if I take decisions randomly, definitely I won't be as good as people or companies who are taking decisions based on data. Cybersecurity. We're going more into a world full of technology, relying on technology, on internet, on computers. So definitely in order to secure ourselves, we need to invest heavily in cybersecurity. We definitely, when certain format or structure grows, we need also to defend it in a certain mean. And defending all what we're talking about, from artificial intelligence to others, we need definitely to defend it via a better cybersecurity. So this could create a lot of opportunities also for investors. It is not an outstanding or booming industry relative to others, but definitely going forward, it's a good defensive industry. Cloud computing, Amazon and other big companies, they invest heavily in cloud computing. Going back since 2010 till today, it's outperforming, and this outperformance is expected to continue going to additional years. We are expecting this industry to grow by additional 100 billion going into the next 3 years, and there are some expectations that during the end of this decade, companies will be spending up to $1 trillion on cloud computing. Renewable energy, so we mentioned oil, we mentioned energy, but going into renewables, we're seeing all this climate change. We've seen floods, we've seen high temperature around the world, and this is forcing many investors, many companies to go eco-friendly, and going eco-friendly means renewable energy. So thus this sector going forward in the coming years, it's a promising industry, and especially with all these Paris climate change conditions and else. So this also puts more pressure on companies to turn into more of eco-friendly companies. Also with Biden's plan for renewable energy, this is very promising for the sector. Biotechnology, genetic engineering was outstanding. This year we've seen how vaccinations changed the world. We were going into a very deep tunnel, and then vaccinations sounded a bit better, and then the world was able to transform due to these inventions. So what about next generation treatments? any next generation treatment that sounds appealing would drag a lot of investment to it, and this is a good opportunity for investors. Many of you will start thinking now that most of these sectors or industries could be already overstretched, but definitely this depends on how you're looking for the company. What are the conditions for your screeners? Always you will be able to find some good companies. Some companies, they are already overbought or they are overvalued, but also there will come a time where it is a good time to buy them again, and then you could follow this train. But definitely we're talking about medium to long-term investment. We're not talking about just trading and scalping intraday like many of stock traders in the region would like to do. Growth versus value. We heard a lot about this starting the beginning of the year. Value, these are two types of, two styles of investing. Value investing, growth investing. Value investing is Warren Buffett's style, which means that we're looking for companies that we believe they are undervalued relative to their performance, their financial performance. While growth, they are where we're investing in companies who are promising higher earnings growth. So this is two diverging views. We've seen since 2008, these charts are relative to the S&P 500. So we've seen that growth outperformed the S&P since 2008. And this drop that we've seen during the beginning of the year, it was due to the rise in treasury yields. At the beginning of the year, the US yields rose to almost 1.77. It was a huge spike. Everyone was talking about the bond market. However, most of these growth companies, they rely on debt in order to fuel their plans for the future. And this makes them impacted negatively with higher yields. So this could be forming a double top formation here, going into a medium where the Federal Reserve will start tightening the monetary policy, lowering asset purchases, driving yields higher. This would definitely weigh on growth stocks. Growth stocks, usually, if you want to compare on indices, we compare between growth and value. So we can go for Dow Jones and S&P, for example, Dow Jones and Nasdaq. We have a little bit of comparison to have. So this could be a good time maybe going forward to consider buying or investing in value versus growth. So we're short on time. We're gonna go over this a bit quickly. We're gonna start with bearish, with bearish drivers going into bullish. So starting with the Evergrande debt crisis, which is new here. Last week they failed to pay for international investors, and today they are expected to pay also 43.5 million, which also they could be using the grace period, the 30-day grace period to pay it, which would put them in default in case they didn't pay it in the next 30 days. So this is a very stressing factor for investors. However, if China managed to land safely the company, this could turn into a positive sentiment going forward, and all these losses could be reversed. US debt ceiling tomorrow is a very important day in the US because there is a standoff between Democrats and Republicans over debt. Republicans, they're trying to limit the spending of the Democrats, while Biden is overholding until now with his plans. Soft Q3 earnings relative to expectations, slow growth, rising inflation. We're going to talk about these going forward. COVID numbers are falling again. This is a bit positive. Now we're on 36,000 cases in the US versus 140 previously. So this is a bit positive. We have a promising holiday season. Many pent-up spending. A lot of jurisdictions around the world were still closed, but now we're moving forward with more unease for movements, and this could sound positive. And Biden's massive spending plans, if they go through, they're positive. So this is the US debt. It's around 28.5 trillion. The Congress suspended or raised the debt limit more than 80 times since 1960. It's now around 28.5. If they do reinstate the debt, they will reinstate it around 28.5, which won't give the government a lot of room in order to borrow more money. So this is a bit stressful. This could be a bit stressful for the market going into October. This is the surprise in earnings during the past couple of quarters. This is due to huge spending, huge investment, huge expansion, but we don't expect this to continue going forward, which could weigh a little bit on sentiment. These are the projections for the Federal Reserve during the last meeting. So they were expecting a better performance during June meeting at 7% for 2021, downgraded to 5.9 due to weakness in August and in September, while they raised inflation. This is a bit bad for stocks going forward. This is the US 10-year yields. We talked about rising yields. Yesterday we rose towards 156, the top of this line, and then we went back today towards 149. Watch out from this break going forward, especially if you're trading or investing in growth companies. This is the rising expectations for the Federal Reserve to raise interest rates during the end of 2022 towards early 2023. These are the cases in the United States falling again, 34,000 cases versus a 7-day average of 120,000. Let's compare a bit US to international. So US S&P 500 since 2007 had 216% outperformance, the DAX 159. So it's clear that the US outperformed others. This would put investors on a certain level where they can diversify their investments again. They can go from overstretched US market into maybe an underperforming European market or Japanese market or Chinese market. This is sound a bit worrying, but what if I tell you that China, if it continues to grow at 6.5% versus US growing at 2.0%, China will outpass the US economy as #1 economy in the world in 2029, while if at 5.5% growth and 2.5% for the US, it would happen on 2033. So this chart could explain to you why Biden is so confident and so overholding his spending plan, because due to this spending, the United States could delay this pass, and this could keep US stock market more appealing than other stock markets in the world. This is, we're gonna end with technical analysis. You can see the S&P 500 since last September. This channel was a 1-year-old channel. You can see how the retracements were towards the 55-day exponential moving average. Investors were buying the dip always. This dip was a bit stretched during September, early September, and we went towards the 100-day exponential moving average and retested it again yesterday. You can see this happened only also last September. So this is not a coincidence. We're going into a bit of a correction. The base case is for this 100-day to hold. The bearish case for the S&P going into the 200-day and the bottom of this channel at 4,200 almost. And the positive case scenario is the 4,650 going into year end and the beginning of 2022. This is it. We still have one more final thought. If you're afraid of inflation and its impact on stocks, if you want to compare stocks to other asset classes, talking about bonds and treasury bills in the United States, the real return takes into consideration inflation. So since 1951 to 2022, the S&P or the stock market continued to outperform the treasury bond or the bond market in general. Definitely investors will still prefer a 7.5 real return to 2.8% real return. That's what makes the stock market more appealing than the bond market. And also if we go back to 1926, the numbers won't change a lot. Still inflation, still stocks, they were able to cope with inflation. Companies were able to move this cost, adding to clients or to purchasers, and they were able to sustain their profit margins. This is all for today's session. I hope you all liked the content. If you still have any answers, we're available at booth 4. Exness do provide the ability to trade stock indices and also individual stocks, also during using leverage and a swap-free. And this could be more appealing for some investors who are looking to really hold the stock versus just trading and using certain short-term trades. So this is all for my session. If you have any questions, please, I'm there.